day traders to identify trades that are not working out before they get to the point where it hits your stop. Now, the decision to cut trades is going to be based on two types of information. First of all, we're going to look inside the candlesticks and analyze certain aspects of order flow that will tell us if that order flow is against us or on our side. In addition to that, we're also going to take a look at various correlated or inversely correlated items that will help us assess the trade. Now, we're going to go through a number of elements that can help you identify if a trade is on side or not. Some of the elements are actually duplicates of others, and we're going to go through which ones are duplicates and which ones aren't. And I'm not suggesting that you use everything that you see on the screen there. In fact, you'd actually be better off to just have a look at this and just add one element at a time, see how it works for you, and then decide to keep that thing or not before adding in something else. And we're going to show you lots of different ways of looking at the same information, because some will just click with you and you'll feel comfortable with them. Some people are very visual, some people don't like reading numbers, and other people do like reading numbers. We're going to focus on the market that I trade, which is the E-mini S&P 500. The concepts are applicable to other markets, but you will need to do your own homework in terms of things like the correlations that you need to look out for those markets. And I warn you that those correlations, inverse correlations, aren't permanent features. Sometimes they will work and sometimes they won't, and you need to be aware of that. So why would we do this? Why would we focus on this? Okay. And it's quite simple. If you averaged 5 contracts per trade and you did 4 trades a day and traded 240 days a year, then an average 1 tick improvement per trade is going to add $60,000 to your bottom line. Because even if you have a stop, it makes no sense to let that stop get hit if it looks like the market is going to go straight through it. Okay? Now, some trades are just going to go straight against you immediately. You all know this. You've all been through it. We've all bought the high of the day and sold the low of the day. Okay? They're going to go against you straight away, and they're never going to go a tick on side. Now, that's easy to spot, very easy to see, but in some respects, those trades are the hardest ones to cut early, because quite often they don't actually give you time to watch the action play out. So the easiest trades to assess if they're going to fail are actually the ones that rotate around your entry points just after entry. Now, you don't have to cut a losing trade just because it goes against you a few ticks. In fact, it's pretty normal for a trade to go against you right at the start. But where it gets interesting is when a trade, say a trade moves against you 4 ticks and then comes back to your entry price and cannot move through it in your favor. Or when a trade goes up 3 ticks, a long trade goes up 3 ticks from your entry point and then moves back against you and can't make another tick up in your favor. Those are the kind of things that we're going to be looking for. So those are the situation where cutting a trade early isn't just jumping at shadows at the sight of a few ticks loss. Okay, so we're not just saying, oh, it's gone against me 3 ticks, exit, because that would be stupid. You'll lose a lot of money doing that. Now, not only will these techniques allow you to cut losers early, it's actually going to let you take more trades. Okay, so once you get proficient at working your way out of a bad trade, you can actually take more shots at the market, knowing you can work your way out of a loser and knowing when you can work your way out of a loser. And this is especially true if your trade is in a place where it's going to take time for that trade to work against you. Okay, and that's something we're going to be looking at as well. The potential for a loss to occur slowly or quickly, and the prospect of the market giving you a second chance to exit. So there's going to be trade locations that we're going to look at where you should lose slowly. Okay. Now, once you've been through the theory, we're going to put some trades on. We're not going to wait for a setup, because we could wait an hour for a setup. So if there's nothing clearly setting up, we're just going to put on random trades and then look at the elements that we talk about in theory and make a call on whether to cut the trade or not. Okay, so everybody clear on that? Okay, so let's move on. So the first thing we're going to look at is order flow, but we're actually going to look at, when I say order flow, the first thing we're going to look at is market orders. So the most important thing to look for, in my opinion, is the flow of orders in the market that you are trading. So if the flow of orders is aggressively against you and the price moves against you, there's really not a lot of other things to consider. So if they're just hitting into your market aggressively and moving down towards your stop, you don't really need to say, oh, what's the other market doing, or what's the market internals doing, or you don't really need any of that. Okay. Now, market orders, reading market order activity is also something known as tape reading. It's also something known as order flow analysis. And what I'll do is I'll just take you through on the screen now which elements represent the actual trades that are getting hit into the market. Okay, so the first one we're going to look at, this screen here that we're looking at, this is a depth of market. It is a slightly different depth of market because it actually shows you the orders. But if we look in the center, almost in the center, we've got a red number on the left and a blue number on the right, and that is actually the market orders, and the red numbers are the market sell orders at each price level, and the blue numbers are the market buy orders at each level. And looking at it from this perspective, because this is just one of a number of ways that we can look at the flow of orders. Looking at this perspective, what we're quite often looking at is simply how easily does the price move up versus move down. So does it move up 1, 2, 3, 4 prices, back 1 price, stay there for a few minutes, then up 1, 2, 3, 4 prices, back 1 price. So we're looking for not just the actual numbers themselves, which are important, but how is it flowing? How is it moving up and down? Okay. And also, what are the numbers doing? So you might come to a price you might come to a price and just trade 10 contracts at that price, and then come back down, go back to that same price, just trade 10 contracts, come back down, go back to the price, do 10 contracts again. And you know that when it gets that price, nobody wants to trade into that price. So if you're long and you see that it gets to a price, nobody wants to buy that price, that's a sign that your trade's going to fail. Now, if you go to a price 3 times, and each time you trade 1,000 contracts at that price, that's a lot more likely to be on your side. And that's quite normal. So we don't just say, oh, it can't get through that price. We have a look at what's trading on each side. Just censor that. Okay. Now, the other thing we'll look at is how many attempts it will make to move through a price. Okay. Because if we keep going to a price and we can't move through it, time will become a factor. Okay. So if you keep going to a price and 2, 3, 4, 5, 6 minutes goes by, eventually the opposite side will just come in and they'll push the market aggressively in the other direction. So if we find ourselves, when we're looking at the actual trades, that we actually get to a point and we just seem to sit there and not able to go through it, regardless of how much trading activity is going on in terms of number of contracts, chances are that's going to move against us. So that's one way of looking at actual orders that are executed, and that's just showing us buys on one side, sells on the other. Another way to look at that is this window to the right, and we've got 3 red and blue, we call them strength meters. Okay, now let me just reset the strength meter. Okay, so what that shows us, that is also showing us the market buys against the market sells. Okay, so the red background is showing me how many sell market orders since I did a reset, and the blue background is how many buy market orders since I did a reset. And what we can see right now, we're predominantly sellers since I did the reset. Okay, so again, this is just a different way to look at market orders. One of the advantages of this, it's a very good thing that it shows you the totals. And in a decent move up, you would expect buy market orders to be between 1.5 to 2 times the sell market orders. And vice versa, if it's moving down, sell market orders should be 1.5 times to 2 times the buy market orders. Now, that size should be accompanied with a moving price. So if you have overwhelming volume selling, but price isn't moving down, then those sellers are getting trapped. So that's another perspective of order flow. So what we're seeing in the columns, the center columns on the market depth, and what we're seeing on the leftmost strength meter is essentially the same information, just a different format. Okay. Then we move further to the right, and we can see we've got 2 time and sales. Now, first of all, let me just comment on the price. You can see a price on those time and sales. Okay, the price is 12.25, and I got 100 contracts. So we actually truncate the front of the price. So what you're actually seeing there is 100 contracts traded at 12.25. Red is a sell, green is a buy. And so what we've got there, we've got a time and sales on the left that is showing us transactions over 100 contracts, and a time and sales on the right that is showing us transactions of any amount of size. And most people use the one on the right that's showing all size to kind of just see the flow. So some people just want to see the streaming contracts going past to get a good feel of the flow. Personally, I don't do that. I don't really use that. I will use the filtered time in sales for contracts larger than 1,000, and what we can larger than 100. And what we can see, if we look at that, from 12.25 down to 12, we had a whole series of large trades hitting into the market, large sell market orders, and the market could not move down. Okay, so if you're in a short position and you see this, you see all of these sell market orders, but price doesn't move down a tick, those sellers are getting trapped. So right now, the people that sold at that level are going to be sweating a little bit and are going to want to see the market go down. So as we come down to 17.12, they're going to want to see that market go down. If it doesn't, they're going to end up bailing out at some point. Okay, and we have to understand the dynamics of that, because we need to understand not just are sellers selling, but are they actually getting anywhere with their selling, or are they getting trapped? Okay, now we had somebody asked about the 2 center columns. When do they reset? Okay, so right, it's a good question, because if we see in those 2 center columns, it does move away from a price, and when it comes back, it'll reset. And what it's actually doing, it's actually saying, okay, if I leave an area for a long time relative to the market, then when I come back, I'm going to reset so that I can actually see what's trading this time round. So this isn't like a footprint that's cumulative, that always keeps getting added to. It's just showing you this time round. But if we pop out of a price and then pop back to a price, then it won't reset, because if you just move up for a tenth of a second, move back down to a price, you didn't really stop trading that area. Okay, so the key to reading information about market orders is very simple. If sellers are dominant, then price should move down. If buyers are dominant, price should move up. In an up move, we'll see 1.5 to 2 times buyers and sellers, and the reverse for a move down. Okay, the other thing we look for is that when large traders start to come in, like we've got these large sellers coming in, that's generally good for a reversal if they get to push the price down. Okay, and there are times when one side is dominant and price stops moving their way. Sellers might be dominant, but we reach a price like we have here where sellers were dominant, but we got down to 12 and they just couldn't get through it. Okay, now sometimes when you can't get through a price, it can be just a temporary pause, but quite often, as we're seeing right now, these sellers are getting trapped. Okay, doesn't mean they're not going to actually be able to push it down some more, but those sellers, large sellers, were selling all the way down to 12.00, and they've not got through 12 since they started doing that. So we always look at the order flow or the tape alongside the price movement it generates. Okay, so that's one aspect, market orders, tape reading. That's one thing we're going to consider. Okay, the other thing we're going to consider are the limit orders. And the limit orders on the dome are basically the inner column with the red background and the inner column with the blue background. And I know some people will be very knowledgeable in order flow and some won't, but basically those limit orders are basically people waiting for somebody to trade with them. The red ones are guys that want to sell and they want somebody to come to their price so that they can sell to them, and they have to be consumed by market orders, and we can use that to get price improvement on our exits, and we're going to see that after we've gone over the theory. It's the first thing we'll talk about. But market orders have to consume those limit orders. So at 17.13.25 I've got just over 2,400 contracts. I'm not going to be able to move up unless those 2,400 contracts either get pulled out of the market or we trade into them. Okay, now the size of limit orders varies day to day, but it's generally within a range. So the Nasdaq is between 60 and 200 contracts a level, and the S&P is usually 1,000 plus, and we can see on there that it's that mostly the levels are over 1,000. The lower those numbers, the more volatile the market. Okay, so if we only see 600 or 700 on the ES, it means it's going to be a very choppy day to trade where the market's going to be whipsawing around. We saw that over the last couple of days. Okay, so the limit orders, it's less important than the actual tape reading, okay, because it is full of fake orders, okay, but when the market moves down, you should see decent offers on this side, the red background. You should see decent numbers moving down after the market, okay. If those numbers go from being big to really silly, okay, so when we start to move, I mean, we can see a little bit. If we look on the bid side, we've got 2,000, 2,300, 1,700. We've got some fairly big numbers on the bid side. When you see huge numbers right below the market, that is a sign that that side of the market will fail. Because basically what happens before a move ends, they need to try and convince people to go on the opposite side of the market. So if they're trying to convince people to buy now, they put on a lot of big bids. People see that, they buy, and then they pull the bids and the market goes down. They were just trying to get you to buy so that they could sell. Okay, so if we see very, very large bids under a move up, it's usually the end of the move up. Okay, so we've got limit orders there, and we will be looking at that. It's not as important. The other place we can see limit orders is on this strength meter, which is the column in the center where we've got 6,000, roughly 6,000 against 6,000. That's just showing the sum of the first four levels. And again, as you move up, you should basically see fairly balanced, but just a little bit higher to the blue side as you actually move up. Okay, now one of the key things about this, when we actually decide we want to exit, if there's a really large bid or offer in the way between us and the stop, we might just let it trade to that point and actually see what happens. So if there's 2,000, if my stop loss is at 17.10 and I'm going to have to buy at 17.10, and I see a large bid at 17.10.25, I'm going to let that bid. See what happens at that bid, and let it trade. And then, okay, if they trade into it and that bid shrinks, then that's fine. If that bid doesn't shrink and it stays firm, there's no real reason for me to exit. Okay. Right. The next thing we're going to look at is the volume profile. And I would say, if I had to pick just one thing for you to take home from this webinar, is that you should start to use the volume profile if you're a day trader. Okay, so very simply, the volume profile is this column here, and all it shows is the volume at price. It just shows where the trading took place, but it also shows you where the stop losses are. So if we look now, we've got from 17.11.75 to 17.12.50, we've got a chunk of volume on the volume profile, and every trade in the market is a buy and a sell. Okay, but when we've got a concentration, a chunk on the volume profile there, as we move down from that area, we know we're going to have people long and short positioned in that area. But as we move down from that area, the shorts are going to be quite happy and stay in their position. But the longs that were concentrated in that area, as we move away from it, they're going to get very nervous and they're going to start to bail out. And that is why when we see these thick areas on the volume profile, we know that the stop loss is either side of those areas. So right now, probably the worst place for you to have a stop loss would be 1711.50 or 1711.25, because it's roughly in that area where people are going to bail out. If you've got a stop loss down here, 1075, again, there's not much stopping the market going through there. Okay. Now, the other thing about these thick areas on the volume profile, when it gets to a thick area on the volume profile, so if we move down now to 1709.25, it's a little bit thicker down there, we can reasonably expect the move from 1150 down to 1709.75 to be fairly rapid, and then for it to slow down as it enters the thicker area below. Okay, so when you're in an area, so if I'm long, for instance, and I go long 1709.75, which if the market comes down, a long at 1709.75 is actually quite a reasonable trade. And it's reasonable because there's not much volume traded above you, and below you there's a lot of volume traded. So if it does move against you, the chances are it will actually come back and give you a chance to exit again. And also if it moves against you, the chances are the move against you will be fairly slow. So again, when we actually get into live trading in a few minutes, we're going to look at where we are and if it's actually a safe place. So we can see now as it's moving down, we can see it's gone from moving slowly, ticking up and down slowly, to kind of moving a little bit faster. Okay. And we'll also look at volume clusters. And again, we'll go into volume clusters when we place a trade. But again, volume cluster, if we look above this area now, 1711 to 1712.50, we've got a thick area on the volume profile. If you look down at 0925, that's something called a volume cluster. So a volume cluster is really just an area where one or two prices we've got exceptionally high volume, and those kind of areas tend to be pivotal in the market. Okay, so the next thing that we're going to look at is correlated and inversely correlated markets. Now, all markets have got correlations and inverse correlations, whether you're looking at currencies or grains or fuel. And mostly those correlations are kept in step because of spread and arbitrage trading that is mostly electronic that keeps these markets in line. So if we look at the markets we're looking at right now, the NASDAQ here on the left is correlated with the S&P. It will generally move where the S&P moves. The 10-year note on the left is usually inversely correlated with the S&P, and today it isn't. Today I can see that as the S&P moves up, the 10-year note doesn't move down. So I'm going to say we'll forget that. Let's just take that off. We're going to take that out of the equation because it's irrelevant today. It doesn't go from inversely correlated to uncorrelated, but basically the reason that the bonds, the US Treasuries, aren't inversely correlated on quite a lot of days now, it's due to the economic things that are going on, mostly with the Fed's taper or the potential Fed's taper. So what we're looking at here is we're looking at the NASDAQ, and what we'll generally see, the NASDAQ is a thinner market than the S&P, so the NASDAQ will wiggle around more. The reason to use an inversely correlated screen, there's no real reason to use it. The only reason I'd use an inversely correlated market is because in the case of the 10-year note, it's also a very thick instrument. So if you're used to following something with thousands of contracts on each side on the dome that's not very volatile, then you could say, I'm going to trade the ES, which is not very volatile, and I'm going to watch the 10-year note, which is not very volatile. Or you could say, I'm going to watch the ES that isn't very volatile, and I'm going to watch the NASDAQ that is volatile. Okay, so one way we can look at correlated market is by looking at the dome. Okay, looking at the depth of market. Another way that we can look at a correlated market, obviously, is the chart. So at the bottom I've got the S&P and AS 900 tick chart, and I've also got the NASDAQ. And again, you're just looking for the same thing basically. If you're in a long trade and the NASDAQ starts heading down and your long trade starts to fail, it's just a little bit more fuel on the fire in terms of, right, we actually need to think about exiting now. Okay, the next thing that people look at is market internals. So if you don't know about market internals, the tick, the NYSE tick is here, and the S&P 500 tick here. All that the tick says is how many, the NYSE tick says how many stocks in the New York Stock Exchange are ticking up versus ticking down. So if the last price move in a particular stock was upwards, that's a tick up. If the last price move was a tick down, that's a tick down. And what you see here, this tick chart, it's actually an average of that tick. It's me taking the open, high, close of the tick and displaying it. Now, you would probably say, okay, if you're going to use the E-mini S&P 500 futures, why would you look at the NASDAQ, the New York Stock Exchange tick, and not the other tick we've got there, which is the S&P 500 tick? So with the New York Stock Exchange, you've got roughly 2,800 stocks that take part in that market. With the S&P, there's 500. It's the S&P 500. Okay, and my observation is that NYSE tick is better at measuring the overall direction because it takes time to turn around, and the market tends to turn around with it. With the S&P 500 tick on the left, it's a lot more volatile, and it tends to turn up and down with every minor move. So I actually don't use the S&P 500 tick, but I'm just keeping it up there for the sake of this webinar. And the last thing we're going to look at is on the ES chart. Okay, what can we see there? I hope you can read the numbers on there. But basically what we can actually see, we've got, if I look at the last swing down, I can see minus 12 and 29k. So the minus 12 is the number of ticks in the move, and the 29k is the volume in the move. Okay, and the reason that we show that is because if the market does trend, okay, if the market is doing a typical S&P 500 day, move up 10 points, down 10 points, up 10 points, as it's moving up, the upswings will have more volume than the downswings, and the upswings will also be more ticks than the downswings. If it's a range day, it's not going to do that. Okay, so again, it's just another piece of information. The tick chart, you should see the tick chart at the bottom of the screen, ES 1213. Can everybody see that? Or am I chopped off? Yeah, okay, you might have to scroll down. But basically, we're just looking at volume. So if overall volume is to the downside and I'm in a short trade and then overall volume starts going to the upside, then, okay, I need to start thinking about exit. Okay, so first of all, before we go any further, the best way to stop yourself out. What is the best way to get stopped out? Okay, so a stop loss order is an order you have at a price. Let's just create a stop order. Okay, a stop order is an order I have at a specific price. Okay, and it's not a very smart order. Okay, because what a stop order does, it says if I get to a particular price and one contract trades at that price, then I'm going to stop out. Okay, and the problem with that is what happens if we look at the bids and offers there. What happens if I have a stop order at 13.25? I've got 1,500 contracts there. Okay, so those 1,500 contracts have to trade at that level before price moves through it. So why would I actually let my stop trigger when one contract has traded at that price? Okay, so one of the things I'm going to suggest to you is that if you're using stop loss orders, and hopefully we'll get to see this today, is okay, don't just stop out when one contract trades there. So I'll tell you what I do. If my stop is 8 ticks, then I will put a stop loss order at 10 ticks. but my stop of 8 ticks is in my head, and when we get to that price, towards that stop price, I'm going to have a look at how many limit orders are at that price. Okay, if there's a couple of hundred limit orders at that price, then I'm going to actually move my stop to that price because I know there's not enough volume in front of me to take a chance on letting it play out. If there's 1,000 or 1,500 contracts in front of me at a price, I'm actually not going to put a stop loss order there, but I'm just going to hover my mouse over the flatten button. And if we get to that price and we trade 300-400, but there's still 1,000 contracts left, I'm going to stay in. I'm not going to exit while there's 1,000 contracts in front of me. And then I'm going to let that play out. And you'll be amazed how many times you will get to your stop. You will see a whole bunch of contracts trade, but you'll see that there's more and more limit orders coming in at your stop. And actually you don't need to exit yet. You can let this level play out a little bit. You can let this level trade. And as trades hit into that level, you can stay in. If the level comes down to like 300, 400 contracts, okay, get out. But quite often it will come down to your stop level. It will trade, it will bounce up, and there'll be a trade that you can rescue. Okay. Now you don't always need to do this. If the market is tanking in one direction, then don't do this. But if the market's moving moderately like we are now, you know, say up to this 1325, we've got 1,200 orders there. Okay, now 800. 700, okay, 600. Now it would be time to say, okay, I'm actually going to exit. It looks like it's going to move through that level. Okay. Okay, so any questions so far? I know there's